So we want to talk specifically about the banking sector. Now, Fed Chair Powell faced questions from lawmakers on the Fed's response to the banking crisis. With new regulations on the table, Powell raised concerns of how higher capital requirements could impact lending. A frustrated Senator Elizabeth Warren pressed Powell on his responsibility for the failures and the need for further action. Let's take a listen.
You take responsibility for your actions that led to the failures of these banks.
Yeah, I think the question of what happened, supervision was at fault. That's both at the board and at the Reserve Bank.
And are you ultimately responsible for those supervisors? Are you
Actually,
in charge
under the law, the vice chair for supervision has
Okay, so you take no
authority.
responsibility.
I didn't say that.
Well, that's what I'm trying to ask. I'm trying to understand what you take responsibility for.
I take responsibility for addressing the situation appropriately.
That's talking about going forward.
That's my focus. It's going forward.
Yeah, well, that kind of sounds like not taking responsibility for what you've done in the past.
We want to bring back in Cole Smead, Smead Capital Management CEO, and Simeon Hyman, ProShares Global Investment Strategist. So, Cole, I want to start with you. I don't know if you could hear what Senator Elizabeth Warren was pressing Fed Chair Jerome Powell on, asking about where, if he takes responsibility. Do you think that was a fair line of questioning?
Fair. I mean, it's politics. All's fair. I mean, that's the problem with it. So I would say I love Elizabeth Warren, just so we're all on the same page. Anytime she chastises an industry or an arena, you can make a pile of money in that space. So her sentiment is well heard. At the same time, I think if you think about the incentive structures of the regulatory environment right now, okay, if a senator comes after you for that, you're naturally, as the Fed, going to say, great, you know what? I want fewer banks to regulate because who wants to sit in that chair? Who wants to be Jay Powell? Who wants to be the vice chair of supervision, for example? You're not going to want to. So we're going to go from 10,000 banks in the United States of America to somewhere closer to 7,000 looking forward. We're going to lose 3,000 financial institutions. There's going to be less competition. Why? The incentives show that we're going there. It is not easy to regulate these banks. And at the same time, could someone say, yeah, the Fed hastened the decline of those institutions? Well, they could, because the rate hiking cycle was so hastened because of their lack of willingness to raise rates while things were quote unquote transitory. At the same time, those institutions did very stupid things. We could all read into the First Republic saga. It was just pure idiocy. And the reality is that's not Jay Powell's fault. I do not envy Jay Powell's position. I'd much rather get chastised by Elizabeth Warren and be in the money management business because I can make way more money.
So, I mean, how responsible do you think the Fed is right now or was here in terms of the current situation with the regionals? We have seen some stability, obviously, like Cole was just saying. A lot of those situations were one-off type of scenarios, very specific to what was happening inside those specific banks. But when it comes to, more broadly speaking, the tighter lending conditions, what that could look like here going forward, how has the Fed played into that?
So I'm sometimes surprised that the focus is so much on the regionals. So first, the good news, it's not a banking crisis. You know, we have 50% more capital since the financial crisis. Tier 1 capital is 15% instead of 10. That's protective. Number two, credit spreads have not budged, even at the height of all this stuff in March. But profitability is, of course, a concern. Those net interest margins are shrinking for both the regionals and the large folks. You get 5% on a money market, and we all have 2.5% mortgages. That's a problem, even if you didn't load up on long-dated treasuries. But the large cap guys have an extra hurdle. Number one, they may have to have even more capital, and they may have higher FDIC fees. So no crisis, but absolutely a profitability challenge that may be at least as heightened for some of the mega banks.
And so do you think bank capital requirements need to be raised? Because that's one of the ideas that's on the table.
It's not that I have opinion. It just looks like it's likely to happen.
And Cole, your thoughts on that?
Yeah, I think it would be foolish to raise bank lending, bank leverage requirements. I mean, because it will drive, to Simeon's point just a second ago, it's going to drive the larger financial institutions that already have those requirements to have more strength. And is that going to really create more competition? But if you're a politician, again, it's an excellent whipping boy to say these banks, they're problematic. Here's what they always create as crises. And to Simeon's point, this was not a credit crisis. This is not anywhere near the kind of problems we've had from a credit perspective in the past. It was a particular group of institutions doing stupid stuff. And there were more than just the ones that went out. We're going to clean up the banking sector because we haven't talked about commercial office yet. I mean, go look at Manhattan. We're back to 50%. It's like a big party's being thrown. And the reality is commercial office has got 2 to 3 years of refinancing problems coming.
So given that, Cole, are you avoiding regional banks at this point?
No, you want to dig around in there. The question is who has large exposure to those kind of things. Therefore, you don't know how bad it could be versus, if someone's, really long single family residential loan books, for example, that's a completely different game. Are you talking about defaults or people walking away from the building? No, the equity's too big. The question, to Simeon's point just a second ago, what's your spread? What are your cost of deposits against those loans that you have out in liabilities? And how bad have you been hurt by the rise in interest rates? But one other thing I'll add, I think the other idea that's going on in banking is that no one's going to borrow money at 6.5% or 7%. And that's just false, because with inflation running at 5%, that's only 1.5% to 2% real interest rates. That's a fabulous mortgage in real interest rates. And we haven't totally turned the psychology over to that yet. But go look at the building starts that were reported earlier this week. Housing hasn't fallen apart despite the fact that affordability's got a lot worse. And that's something that people said would have to happen. And yet, again, that's not something going for the Fed. Housing's not falling apart. That doesn't give them room to cut.
And Simeon, I got to ask you, so you guys have both made the points. Obviously, this is not like the financial crisis, but what are you advising clients with regard to exposure to the financials?
Look, there's certainly an opportunity to avoid financials in large cap stocks. We actually have a S&P 500 X Financials ETF for those who want to do that in very straightforward manner. But in regionals, you can pick and choose. I think I would align with that point of view. If you go back to the great financial crisis, remember some of those regional banks, they didn't want that TARP money, and it was kind of forced on them.
It was to make it look like
because we weren't supposed to see who were the good guys and who were the bad guys. So for the folks who may, know who they're lending money to very well and have very specific loan books, there's certainly some opportunities there.
All right, we're going to leave it there for now. Cole Smead of Smead Capital Management, CEO, thanks so much for joining us here. And Simeon, stick around.